Right now, something massive is happening in the global metals market, and most people have absolutely no idea it's even going on. China is quietly buying gold at a pace that hasn't been seen in decades. At the same time, silver is disappearing from COMEX warehouses at an alarming rate. And when you connect those two things together, the picture that emerges is one of the most important financial stories of the decade. So why is nobody talking about this on mainstream news? Why are the biggest financial channels staying silent? That's exactly what we dig into here at the Quiet Markets. The stories that the loud voices don't cover. Welcome in. If you're new here and you care about real money, real assets, and what's actually moving markets behind the scenes, hit that subscribe button right now and tap the bell. We drop content that most channels simply won't touch, and you don't want to miss what's coming next. Let's start from the very beginning, because to understand what's happening today, you need a little bit of context. Gold and silver have been money for thousands of years. Empires rose and fell on the back of these metals. And even in a world of digital payments, blockchain, and fiat currencies, the world's largest governments and central banks still hold gold as their ultimate reserve asset. Silver is different. It's both a monetary metal and an industrial one. And that dual nature is what makes the current situation so explosive. Now, let's talk about China. Because China's behavior in the gold market over the last few years has been extraordinary. The People's Bank of China, that's China's central bank, has been adding gold to its reserves month after month, and that's just the official number. Most analysts who study this closely believe the real accumulation is far, far larger than what Beijing is publicly reporting. Think about that for a second. The world's second largest economy, with the world's largest manufacturing base and the largest population of middle-class savers on the planet, is aggressively moving into gold. That doesn't happen by accident. That's a deliberate, strategic decision made at the highest levels of the Chinese government. But why? Why would China be doing this right now at this specific moment in history? The answer starts with the US dollar. For decades, the dollar has been the world's reserve currency. Oil is priced in dollars, global trade is settled in dollars, and countries that want to participate in the global economy need to hold dollars. That gave the United States enormous power, the ability to print money, run deficits, and impose financial sanctions on any country it chose. Then came 2022. Russia invaded Ukraine, and the United States, along with its allies, did something unprecedented. They froze Russia's foreign currency reserves. About $300 billion in Russian assets were essentially locked up overnight, and that sent a shockwave through every government on the planet that wasn't fully aligned with Washington. The message was clear. If you hold your reserves in dollars, and you get on the wrong side of U.S. foreign policy, those reserves can vanish with a single executive order. China watched that very carefully, and China drew a very clear conclusion. If you want financial sovereignty, if you want to make sure that your wealth cannot be frozen, seized, or sanctioned, you need to hold assets that nobody can freeze. You need to hold gold. Gold has no counterparty risk. It's not someone else's liability. You can't sanction it. You can't freeze it if it's sitting in a vault in Beijing. And that realization didn't just hit China. It hit Russia, India, Turkey, Saudi Arabia, and a growing list of countries that are now collectively referred to as the Global South. These nations are all quietly, methodically moving their reserves away from dollar-denominated assets and toward physical gold. This is called de-dollarization, and it's one of the most significant macro trends of the 21st century. It doesn't happen overnight. It's slow. It's quiet. It builds for years before the mainstream notices. And that is exactly the kind of story that the Quiet Markets was built to tell. Now, here's where the numbers get really interesting. According to data from the World Gold Council, central banks globally bought more than 1,000 tons of gold in 2022, and they matched that pace again in 2023. Those are the highest levels of central bank gold buying since the 1970s, the last time the global monetary system was being fundamentally restructured. The comparison to the 1970s is not coincidental. That era saw the collapse of the Bretton Woods system, massive inflation, and the end of the dollar's direct link to gold. Many serious economists believe we are in a similar transition period right now, and China is leading that charge. But here's the twist, and this is where it gets really interesting. China isn't just buying gold for geopolitical reasons. There's a domestic demand story happening at the same time that is equally powerful. Chinese consumers are buying gold at record levels. Gold jewelry, gold bars, gold coins, all hitting record highs in China. The reason is actually quite simple when you understand the local context. China's real estate market, which was for decades the primary savings vehicle for ordinary Chinese citizens, has been in serious trouble. Major developers like Evergrande collapsed. Property prices in many cities have fallen sharply, and millions of ordinary Chinese people who had their savings tied up in property have watched the value of that investment decline. Where do you put your money when real estate is failing? In China, the answer is increasingly gold. It's culturally familiar, it's tangible, it holds its value, and unlike stocks or bonds, you can hold it in your hand. Chinese retail demand for gold has absolutely surged as a result. So you have this double-barrel demand story in China. Government and central bank buying on one side, massive retail and consumer buying on the other side. And both are happening simultaneously. That is an enormous sustained demand signal for gold. And the global gold price has responded. Gold has been trading at or near all-time highs, and many analysts see this trend continuing for years, not months. Now let's shift gears and talk about silver, because silver tells a different, and in some ways even more urgent, story. COMEX is the main commodities exchange in the United States where silver futures are traded. Think of COMEX as the global price-setting mechanism for silver. But here's the thing about COMEX that most people don't fully appreciate. It's a paper market. The vast majority of contracts traded on COMEX are never settled with actual physical silver. Traders buy and sell paper contracts, and most of those contracts are closed out before delivery ever happens. The system works as long as the amount of actual physical silver sitting in COMEX registered warehouses is sufficient to cover any requests for real delivery. And for decades, that system worked just fine. But lately, something has been changing. COMEX silver inventories have been declining steadily, persistently, and the pace of that decline has been accelerating. Let's put some numbers on this. At their peak, COMEX registered silver inventories held well over 150 million ounces. Over the past few years, that number has dropped significantly, with withdrawals happening in large chunks on a regular basis. That silver is leaving COMEX warehouses and going somewhere. The question is, where? Part of the answer is industrial demand. Silver is not just a precious metal, it's an industrial metal with properties that make it essentially irreplaceable in certain applications. Silver is the best conductor of electricity of any element on Earth. It's used in solar panels, in electric vehicles, in semiconductor chips, in medical devices, in water purification systems. And as the global push toward green energy and electrification accelerates, industrial demand for silver is rising every single year. The solar industry alone is consuming silver at a pace that is genuinely staggering. Every solar panel contains silver paste used in the photovoltaic cells. And as countries around the world, including China, by the way, massively expand their solar capacity, the demand for silver in solar panels keeps going up. Estimates from industry analysts suggest that the solar industry could consume nearly half of total annual silver supply in the coming years. Just one industry. Add to that electric vehicles. Each EV contains significantly more silver than a traditional combustion engine vehicle. Add to that 5G infrastructure, which uses silver extensively. Add to that the general expansion of electronics globally. The industrial demand picture for silver is extraordinarily bullish. But here's the problem. Silver mine supply is not growing at the same pace. Most silver is actually produced as a byproduct of mining other metals. Copper, zinc, lead. You don't mine specifically for silver very often, so when industrial demand rises sharply, there's no easy lever to pull to quickly increase supply. The market can't just spin up new silver mines overnight. It takes years and billions of dollars. This means the world is on a trajectory where industrial demand for silver will, at some point, outpace supply. And that creates what analysts call a structural deficit. A structural deficit means you're consuming more than you're producing, year after year. And the only way to make up that gap is to draw down existing stockpiles. Those stockpiles, a significant portion of them sit in COMEX warehouses. And that's exactly what we're seeing. Those warehouses getting drained steadily and consistently as the real physical metal gets pulled out to meet real-world industrial demand. Now layer on top of that the investment demand for silver. When investors around the world start realizing that silver is facing a supply crunch, they start wanting to own physical silver too. And that creates a feedback loop. More investment demand, faster drawdown of stockpiles, tighter supply, higher prices, more investor interest. There's another dimension to this that doesn't get enough attention. The gold to silver ratio. This is simply the price of gold divided by the price of silver, and it tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged somewhere between 15 and 30, reflecting the rough, natural abundance of silver versus gold in the Earth's crust. Today, that ratio is trading around 75 to 80. That means silver is historically very cheap relative to gold. Some analysts argue it's the most undervalued major asset in the world right now. Every time in history that this ratio has gotten this stretched, when gold has gotten this expensive relative to silver, silver has eventually caught up, sometimes dramatically. If silver were to revert to even a 50 to 1 ratio with gold at current prices, the implied price of silver would be significantly higher than where it trades today. And if the ratio were to revert toward historical norms in the 20s or 30s, the implied silver price would be extraordinary. Now, ratios can stay stretched for a long time. Markets don't correct on a schedule, but the fundamental imbalance is real, and it matters. So let's bring this all together, because here's the big picture that emerges when you connect China's gold rush with the COMEX silver drain. What we're witnessing is a fundamental restructuring of the global monetary system, one that is moving, slowly but unmistakably, away from pure dollar dominance and toward a world where hard assets, particularly precious metals, play a larger role. China is leading that shift deliberately and strategically, and the ripple effects of China's behavior are being felt across every commodity market on Earth. When China's central bank buys gold aggressively, it signals to every other central bank in the world that gold is important, that gold is worth holding. That signal has already triggered a wave of central bank buying across the global south, and that wave is ongoing. When China's consumers pile into gold because their real estate market is broken, it creates sustained civilian demand that competes with industrial and investment demand globally. Gold supply is relatively fixed. It takes years to open new mines, so increased demand means higher prices. And silver? Silver sits at the intersection of the monetary world and the industrial world. It benefits from the same safe haven hard asset demand that gold does, but it also sits right in the crosshairs of the green energy revolution. The solar panels, the EVs, the electronics, all of which are consuming silver at record rates. And the physical silver sitting in COMEX warehouses is the world's most visible buffer stock for that demand. When that buffer gets thin, the market will notice, and it will respond. We are in the early innings of what may be a multi-year, potentially multi-decade shift in how the world stores value and manages reserves. The countries that understand this and position themselves accordingly, whether that's governments accumulating gold or individual investors recognizing the silver opportunity, are the ones who will come out ahead. Here at the Quiet Markets, we believe in giving you the full picture, not just the price action, but the why behind the price action. Not just what's happening today, but what the trajectory looks like over months and years. Because real financial intelligence isn't about chasing last week's headlines. It's about understanding the forces that are shaping the next decade. And right now, those forces are pointing clearly in one direction. Hard assets, precious metals, and the gradual erosion of dollar-denominated reserve dominance. Whether you're an investor trying to protect your wealth, or just someone trying to understand why the world economy feels increasingly unstable, these trends matter to you, directly and personally. Here's what I want you to take away from today's video. Number 1, China's gold buying is not a passing trend. It is a deliberate, multi-year strategic repositioning that has the full backing of the Chinese state. It will continue. Number 2, COMEX silver inventories are declining because real physical demand, both industrial and investment, is outpacing supply. This is not a manipulation story or a conspiracy theory. It's basic supply and demand. Number 3, the gold to silver ratio suggests that silver is historically undervalued relative to gold, and history suggests that gap eventually closes. Number 4, the macro backdrop of de-dollarization, geopolitical tension, and the green energy transition all point to sustained long-term demand for both gold and silver. Now here's what I want you to do. Drop a comment below right now and tell me, are you more bullish on gold or silver going forward, and why? I read every single comment, and I genuinely want to know what you think. Your perspective matters, and sometimes the best insights in the comments come from people who are watching these markets from angles I haven't considered. And if this video gave you something real to think about, if it connected dots that you hadn't connected before, please share it. Share it with a friend, share it in a group, share it with anyone you know who is paying attention to their financial future. These are the conversations that need to be happening more broadly, and you sharing this video is how that happens. We are living through a genuinely historic moment in financial history. The tectonic plates of the global monetary system are shifting. Most people won't see it until it's obvious, until prices have already moved and the opportunity has already passed. But you're here. You're paying attention. And that puts you ahead of 99% of people. This is the Quiet Markets. We'll see you in the next one.